What if I told you that the future value of your Bitcoin, Ethereum, or even your favorite NFT isn't just tied to hype, regulations, or market cycles anymore? What if something far more basic, something most digital asset investors rarely think about, is quietly becoming one of the most powerful forces shaping valuations across the entire crypto space? Forget traditional market crashes. We're talking about something far more fundamental: electricity, power, energy. As the global energy crisis deepens, it may not just raise your monthly utility bill. It could fundamentally reshape the value of every digital asset you own. And if you're not thinking about this connection yet, you might already be behind. The global energy crisis is no longer a distant warning or a theoretical future problem. It is unfolding right now. Across Europe, Asia, North America, and emerging economies, energy systems are under pressure. Demand is rising as populations grow and economies digitize. Supply chains remain fragile. Geopolitical tensions continue to disrupt oil, gas, and coal markets. Renewable energy transitions are slower than expected. Aging power infrastructure struggles to keep up with modern needs. The result is a world where energy is becoming more expensive, less predictable, and increasingly political. At the same time, the global economy is becoming more digital than ever before. Payments, finance, identity, ownership, and even culture are moving onto digital platforms. Cryptocurrencies, blockchains, and digital assets sit right at the center of this transformation. They promise decentralization, efficiency, and independence from traditional systems. But beneath that promise lies a reality most investors overlook. Digital assets are not weightless. They are not free from physical constraints. They are built on an invisible but extremely energy-intensive foundation. Every blockchain transaction relies on servers running in data centers. Every mined coin requires computing hardware consuming electricity around the clock. Every validator, node, exchange, and platform depends on uninterrupted power and internet connectivity. No electricity means no network. No network means no value. This is where the energy crisis and digital asset valuations collide. Many people still believe crypto exists purely in the digital realm, separate from real-world limitations. That illusion disappears quickly once energy becomes scarce or expensive. Bitcoin mining is the clearest example. Proof-of-work systems require massive amounts of computational power, which directly translates into energy consumption. When electricity prices rise, mining becomes more expensive. Margins shrink. Smaller or inefficient miners are forced offline. Some are pushed to sell their holdings just to cover operational costs. That selling pressure doesn't stay isolated. It ripples through the market. Even networks that are considered more energy efficient are not immune. Proof-of-stake systems reduce raw energy usage, but they still depend on data centers, validators, and cloud infrastructure that must operate continuously. Rising energy costs increase operational expenses. Over time, this can lead to centralization, where only large, well-capitalized players can afford to run infrastructure reliably. When decentralization weakens, confidence weakens, and confidence is one of the most valuable currencies in digital markets. Valuations are not driven by technology alone. They are driven by trust, stability, and expectations about the future. When investors begin to question whether a network can operate sustainably in an energy-constrained world, price reacts. Not always immediately, but inevitably. Markets price risk faster than most people expect. There is also the psychological side of this equation. Investors are forward-looking. They don't just react to current conditions, they react to narratives about what lies ahead. As energy instability becomes a recurring global issue, new questions start to dominate investor thinking. Is this blockchain scalable when power costs continue to rise? Can it survive regulatory pressure linked to energy usage? Will governments restrict or tax energy-intensive digital activities during shortages? Does this asset make sense in a world where efficiency matters more than ever? Perception alone can move markets. Even the idea that an energy crisis could threaten digital infrastructure is enough to impact sentiment. When sentiment shifts, valuations follow. Assets perceived as fragile or inefficient may struggle to maintain investor confidence. Meanwhile, projects that are seen as resilient, adaptive, and energy-conscious may gain a relative advantage. Energy is not just an economic issue, it is deeply political. Governments prioritize stability, industrial output, and national security during periods of energy stress. In such situations, digital asset infrastructure rarely ranks high on the list of priorities. This is why mining bans, energy taxes, and sudden regulatory interventions tend to appear during energy shortages. Often, these actions are not driven by hostility toward crypto, but by necessity. When power is limited, governments act fast. Markets respond even faster. Geography also matters. Regions with abundant, cheap energy become hubs for digital infrastructure. Regions facing shortages see activity decline. This geographic shift can reshape networks, influence decentralization, and alter long-term valuation dynamics. Investors who ignore these structural changes risk misreading the future. However, it's important to understand that crises do not only destroy value, they also redistribute it. The energy crisis could act as a filter rather than a death sentence. It may accelerate innovation in energy-efficient blockchain design. It may push mining toward renewable energy sources. It may encourage decentralization across regions with surplus power. It may strengthen narratives around sustainable digital finance. In the long run, projects that adapt to energy realities may emerge stronger than before. Short-term volatility is almost guaranteed. Rising energy costs introduce uncertainty, and markets dislike uncertainty. Prices may swing sharply as investors reassess risk. But long-term value is built on durability, not speculation. Digital assets that prove they can operate efficiently, securely, and sustainably in an energy-constrained world are more likely to earn lasting trust. For investors, energy can no longer be treated as a background issue. It belongs on the same level as regulation, technology, and adoption. Understanding how a project sources power, how energy efficient its design is, and how exposed it is to geopolitical risk will increasingly matter. Valuations will not just be shaped by code, partnerships, or roadmaps. They will be shaped by kilowatts. Your digital portfolio may look intangible on a screen, but beneath every transaction, every smart contract, and every NFT is a very real physical requirement keeping it alive: power. As the global energy crisis deepens, digital asset valuations will not remain untouched. Some assets will struggle, some will adapt, some will quietly position themselves for long-term strength. The difference will not be hype. It will be infrastructure, efficiency, and resilience. Those who understand this connection early will not panic when the narrative shifts. They will already see where value is likely to flow. Because in the end, the future of digital wealth may depend less on speculation and more on something surprisingly traditional: energy.